To another soulless trading video where today I will teach you guys how to trade stock options. Now the thing with stock options is you first need to know what an option actually is. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a specific price before a specific date. So you're buying control over 100 shares for one contract. Now, what are the two calls and puts, the two different options you can buy? We first have call option. The call option, you make money if stock goes up. So you're essentially betting on the growth of that stock. Now the put option is the opposite. You make money if the stock goes down, betting on decline or protection. A couple key terms that we'll talk about and we'll say today in this lesson is number one, strike price. The price you can buy, sell the stock at is called the strike price. The expiration date, when the contract expires. The premium, the price you pay for the option. In the money, already profitable. Out of the money, not profitable yet. Now we'll go through an example later on in the lesson, and all these key terms will be shown and explained on a deeper level. Now, how do you make money or lose money trading options? You make money on options when the stock moves in your favor. The call option, you profit if the stock rises above the strike price, and with the put option, you profit if the stock falls below it. You lose money if the stock doesn't move as expected or moves too slowly. If the option expires worthless, you lose the premium you paid. In short, profits come from correctly predicting price movements within a set time frame, while losses for buyers are limited to the premium. So the max loss is the premium you paid for. So say the premium is $77, that is the max amount of money you can lose. This becomes very important when I later talk about risk and not blowing your accounts. You can sell the option before the expiration date and you don't need to exercise it. So why people trade options? People trade options because it gives you leverage, allows you to hedge, which is essentially a form of insurance in the stock market, and income and short-term trades. A lot of mistakes I see beginners make is trading without a plan, buying cheap out of the money options, holding to expiration, ignoring volatility, and risking too much per trade. These are all mistakes that I've personally made, and I'm trying to teach you guys what mistakes not to make. Now, here's the real world example. We have Intel, ticker symbol INTC. The stock price is $40. Our strike price is $40.50. So, and our premium is $1.23. But we got to times that by 100, which equals $123. So our premium that we're paying is $123. If we buy this call option and the stock grows, our option contract also increases and makes money. So instead of our premium being worth 1.23, if we buy this call option and the stock grows, our option contract goes from 123 to 223. We can then sell the contract for a $100 profit. Now, I have to say this is not financial advice. This is just advice on YouTube. From what I do and from what I've learned, this is just to help you guys get a real understanding of what options really are. Now, in the next video on options, I'll talk about the 3 different Greeks and how they affect the prices and the strategies you can use in options trading. Hope you guys really enjoyed this video. As always, have a wonderful day. And remember, king of the mountain.